Welcome to Grizzle Pod episode 19. How goes? What's up? Got Scott Willis in the house. Tom George. We are Grizzle. We're thematic growth investing, Scott. That's what we do.
And there's a lot of thematic stuff to talk about.
Yeah. You know, if you've followed us in the past, you know we're following every growth sector. We keep a thumb on what moves. But we're not just throwing up tickers, Scott. That's not our thing. We break down the fundamentals, and that's where you're going to learn the building blocks of how to follow growth sectors, and most importantly, how to make money.
Yeah, we're talking about the oil price, then the oil companies, not the other way around. So you're going to have a better handle on what's going on in the broader market. That's key. That's where you start. You don't start with I like Exxon, I like Chevron.
Yeah. So Scott, we got a good episode today. It's a focused one. You know, and I like these focused ones because, you know, we're peeling back the onion, if you will, and laser on something. And today it's commodities. You want to give it the rundown?
Yeah, today's gonna be a good one. We've talked about commodities in the past. Prices have been running ever since vaccines have been rolling out. Now we're gonna go through a few different commodities. We're gonna talk about lumber, shipping rates, oil prices, and copper. And we're gonna tell you whether the price spikes we've seen recently are kind of long-term mismatches in supply and demand, or if it's something due to COVID. You know, there's not enough ships, there's supply constraints, there's a ship stuck in the Suez Canal, that type of thing.
That's right. And, you know, commodities by definition, it really, you do the fundamentals here, you get the story right. So we're going to do a little bit of victory rap on lumber, but the bottom line is if you did the homework on it, you would have known that spike wasn't going to follow through. But we'll talk more about it.
So just as background for everyone listening, Tom and I started on commodities. We spent a lot of time in our careers there. So we understand how important it is. You get the big call right, you're going to make money on any of the stocks you pick unless you get it horribly wrong. Vice versa, you could pick the best stock. If you're wrong on what's happening in the industry, you're going to lose money anyway.
Yeah. So today is a good focused commodity episode. Now, also, Scott, we got to talk about what's coming down the pipe for Grizzle next Monday.
Oh, next Monday is another big day for us.
Yeah, another big one. So, guys, if you haven't already, make sure you go to YouTube, click the, I'd like a reminder, but it doesn't matter because it's going to be coming at you every which way, Scott, every which way. Grizzle Psychedelics Con. It's coming June 28th. Mark your calendars. We'll have the website. So if you go to grizzle.com, you'll be able to click, see all the presenting companies. It's a nice lineup, Scott. I'm going to talk about it. Field Trip, Cybin, Goodness Growth Holdings, Haven Life, Pharmathare, and Mindset. That's the lineup.
Nice.
You know what? What we're really trying to set up the day is to be basically a teaching for everybody, right? Come learn with us, right? We had over 10,000 people listen to Grizzle Cannabis Con. Scott, that was the most successful conference anyone's ever put on.
Yeah, so if any of you missed it, I would go check that out. We had a lot of fun, and we learned a ton about what laws are coming down the pipe in cannabis, learned about different companies, what they're doing. That's what it's all about. You learn, you have a good time. We're going to do the same with psychedelics. Psychedelics is even earlier days, so there's more to understand. And if you get ahead of the trend, this one's huge because this has the pharmaceutical angle and a lot of other things going on. So we're going to be learning along with you. Definitely tune in on Monday.
For sure. And and this is on the heels of Atai Life Sciences IPO, which was tremendous.
Perfect timing. Right? We're up 7% today. Been doing well. Yeah.
Up 40% on the IPO. So, anyways, needless to say, that had a big debut, and we're gonna learn a lot more about companies in the space. And I think it's gonna be a good day of learning, really, Scott. All these guys, they'll have some interesting takeaways for everyone to listen to. And again, we're investing in growth sectors. This is how you do it. You basically fill up a day, try to figure out what everyone's doing, and then figure out which horse you want to ride, or more importantly, how you want to weight your horses. But bottom line is understanding the sector, and hearing what everyone's strategies are.
Yeah, it's a very quick way for you to figure out the different strategies because not every company is going after the same thing. So then you can say, do I buy a whole bucket of these guys? I like everything. and you just learn what's going on in psychedelics, right? Because everyone just says psychedelics, magic mushrooms. It's a lot more than that.
Yeah, for sure. And so, yeah, it's a super exciting day. It's going to be another big one, man. Barn burner. That's what we do. Grizzle Cannabis Con was like off the chain. It literally, the feedback from that, it's now the go-to cannabis conference, period. There's not, nobody can even come close to what we dropped there. And we're going to lead the way again with psychedelics. And I can't thank everyone for their support. So tune in there. That's going to be live on Twitter, YouTube, LinkedIn, wherever you are, we're hitting you. And you don't need logins. You don't need any of that. We're just blasting it out.
Yeah, just tune in. Hang out.
Tune in, hang out. So that's next Monday, June 28th. Stay tuned. We'll have the full agenda, but those are the companies. Go to grizzle.com. You can stay up to date there. And also contest giveaways. Enter your email. You'll get all that stuff. So, Scott, you gave the lineup. Now, we got to thank our sponsor. A big shout out to Y-Charts for helping arm us in at battle every day with stock market.
Y-Charts, man, love it. So, I say it every week. Y-Charts is the fundamental kind of, superpower for us. It helps you visualize things quickly, and it has all the fundamental numbers you need to figure out if a company's making money or losing money. So That's what we use when we do all our deep dives on things. And there's free trials. You can try it, see if it's for you. It does a lot of powerful things that a Bloomberg would cost, thousands and thousands of dollars. Y-Charts is much less than that, so I would recommend give it a shot.
Yeah. Now, I know there's a lot of big baller advisors who listen to the Grizzle Pod, and big up to everyone. A lot of players there, and so if you guys are owning ETFs, etc., Y-Charts has a phenomenal slate of tools there for advisors. So it beyond just the stock specific. You get access to all the holdings, ETFs. It's a phenomenal toolkit for everyone from an advisor to a fundamental analyst.
Agreed.
Yeah, so that's so. Without further ado, Scott, where are we at? Commodities.
Let's start with we got a chart of commodities. Just it's always good to go back in time. You don't want to look just say the last 6-9 months. So Tom pulled up a chart that goes back all the way to the 60s, way back in time. And what's it telling us, Tom?
Well, yeah, this is the chart, Scott. So this is basically what this chart is just saying is, listen, everyone looks now and say, oh, commodities are overblown. And I say, listen, obviously, we've had a big run up, and we're going to talk about some of those reasons over in the remainder of the pod. But I think everyone has to understand where we came from, and that'll give you a good idea of that. This is we are truly, in our view, entering a new super cycle in commodities. Yeah. And that's what this is showing you. You're at the lower band level of commodities. So this is, so what can feel like a big run up in commodities in the here and now, like year over year, Scott, pan back, look really far back, and you see, listen, we're so far away from being anywhere meaningful, right? And that's basically, we're still at a lower bound for commodities, and we have quite a distance to run.
But not all commodities are treated equal.
That's very true, yes. Scott, very true.
So we're going to talk about some of these. We'll take you piece by piece and say what our thoughts are, whether we think there's long-term upside in certain of these commodity prices, or if it's more a COVID-driven bump in the road. To start with, let's look at shipping rates. We know everyone who's been stuck at home, we've been ordering a lot of things. Remember, when you didn't have to social distance, services were what you'd spend a good chunk of your money on, along with things. When you're stuck at home, it's a lot of things. You want to buy your video games, your drum sets, whatever it is. A lot of it comes from China, and it comes on shipping containers. So we've seen the Baltic Dry Index is the way that you measure the price of shipping goods through a container. That has been on a run. So originally it fell off in 2020 when everyone locked down. But then when we saw that huge spike in demand of orders and people are catching up, Baltic Dry is up 3 times since last year. And it's even more acute if you just look at goods coming from China going into the U.S. So we have a chart on that too. That's up 11 times. I mean, that in 2020, we were below 2,000 on that index. Now it's up to 11,000. So this is one of these things where, okay, prices have gone up a lot. There's reasons for that because there's big orders, but there's an interesting fact that was brought to my attention from Twitter. Twitter is such a powerful platform. I mean, this is stuff you get from like a broker, but So there's a guy who tracks orders of new shipping containers. And in just the first 5 months of this year, there's been 2 times the orders of the last 2 years.
Oh, wow.
So that means that basically orders of new shipping containers are running at 4 times normal. So this is what happens with Baltic Dry Index and certain other commodities. Prices go up. Everyone says, well, I can make more money on shipping containers. I'm going to order some. They over order, and then pricing is going to come back down. So I don't know if freight prices are going to come down right now, because we still do have these bottlenecks. We have reopening. People are still ordering lots of things. But it tells you that there's a lot of containers being built. They're going to come. That price is not going to hold in longer term. So this is one of those ones, COVID-driven spike, not going to last.
And, where this basically manifests, right? So obviously we're talking broader commodities, and I would say shipping is a smaller component of the broader commodity mix. But this is kind of like when you get the widget, that widget you need for your bicycle. Yeah. That's when it starts to feed through, right? Because shipping container rates have that broad inflationary impact.
Yeah, they're kind of the base. If the shipping container costs more, the producer who is ordering those bikes has to pass that price on to you. You pay more for your bike. That's inflationary.
Yeah. I was in Mountain Equipment Co-op, so it's a Canadian equivalent. Scott, remind me what the American equivalent. We talked about this. So Scott and I went camping. You know what? And when you go camping, it's always customary to go to the Mountain Equipment Co-op or whatever camping store and drop a lot of money for stuff that you literally use once.
So one of them is EMS, Eastern Mountain Sports, and then I think there's another one. But we figured out that MEC, the Canadian one, basically copied the U.S. one, because the U.S. one was founded 40 years before or something like that.
Oh man! And I was insisting to Scott, and we were camping obviously. And I said, listen, you guys obviously copied the Mountain Equipment Co-op model. We're a socialist country, right? You know what I mean? Or we lead socialist anyways. Of course you're going to have, it's cooperatives, this, that, the other. But anyways, lo and behold, it's whoever makes your tent, Scott, whoever that is. But that was the
I'll think of it.
BFI, I don't know, whoever it was. Needless to say.
Been around for a long time. They make good stuff. MEC makes good stuff too. It just shows that the branding is similar.
Yeah, hippie stuff, But the thing is, what's happened was, Mountain Equipment Co-op in the best time for camping, they ended up going under, right? And now they're taken over by private equity.
Yeah, that was the problem. I guess they just were running on such a low cash balance that they couldn't survive that March, April, May where nobody was doing anything to catch the huge camping wave, which is unfortunate. But whoever bought them out of bankruptcy probably did well.
Oh yeah, it's unfortunate. It's obviously a big history of Mountain Equipment Co-op in Canada, but the other part too is this is kind of, you come back to just the way cooperatives are run versus like a lean, mean capitalist company. These cooperatives aren't really prepared for these shocks, and the wheels come off.
Yeah, they usually need help from their members, and that doesn't let you survive a shock like that.
No. So anyhow, but so I was trying to get to a story. So anyhow,
there's a story in here. I thought you just were talking about how much you love your tent.
No, there's a story. So anyhow, talking about this Mountain Equipment Co-op, but we were looking at bike parts. They literally had a list of like this waiting time for like this derailleur or whatever. Just whatever, parts of 7 months, 8 months, 9 months. I'm like,
wow.
What is this? Like, you know what I mean? But anyhow, that it was kind of an interesting thing where I'm like literally looking at the whole supply chain mess in real time on a board, and they're telling me when I can possibly get that part. It was kind of neat.
Wow.
It was a neat summary of the mess we're in.
So it's going to take time to work this out, and the big question for us is, what does this do to inflation? The longer it lasts, the more inflationary it is. We see in the market now, it's funny how quickly things change. February, March, everyone was worried about interest rates. Government bond yields, which are a proxy for interest rates, were going up. Yeah. Now they're off big. They were down last week. So kind of that worry about inflation is largely dissipating. Everyone thinks it's just due to COVID bottlenecks, it'll go away. So now it's at the point where if you are positioned that does not go away and it ends up coming back in the fall, well, then there's a lot of money to be made, versus it was pretty much consensus back in February, March. Everyone was worried.
That's right.
So we're still going to watch it closely, because that shows that it's going to have even more of an impact if this inflation just keeps ramping 3-4%. Remember, the federal government, their target is 2%. So anything above that, they don't like it.
Yeah.
All right, what's our next commodity we're talking about?
Well, we got to touch on lumber, Scott. This is we were outlining this stuff early, and we're obviously we're saying, listen, this is kind of wacky stuff because there's no shortage of wood, Scott. There's no shortage of trees.
Yeah, so I guess first we had this great chart from way back when we did a big housing segment. It's on the Grizzle pod. I would go back if you want to learn much more about what we think on housing. But we found this amazing chart that looked at the price of lumber, which was going to the moon, and the price of timber, which is the wood in the forest, and that wasn't going anywhere. So that's very weird, right? But what that tells you is the bottleneck are the sawmills turning the trees into lumber. It's not we've run out of trees. So that again is one of those things like the shipping containers. We know a lot of new shipping containers are coming. So this lumber price can't stay like this forever.
Yeah, and those that listened to the pod and saw this graph and said, heard us talk about this graph, but basically this graph's just showing you, listen, you're getting a spike, getting a massive spike in lumber, which is the end product, but timber prices are pretty much remaining like what they were the last 10 years. You just say, hey, listen, I'll do that deck next summer.
Yeah.
And those that took the pass on it, the FOMO, I would say so much in it, and we're providing tidbits for everybody, right? Everything comes back to real life. But so the number of people that were approaching me that had FOMO because everyone's still still trapped doing the backyard, kind of make it into a palace type thing, Scott. I'm like, listen, man, I would just hold off paying these prices for your decking right this moment.
You didn't have to wait long. Some of the lumber guys I follow, they're saying they're seeing in the pipeline prices are down 50% wholesale. So it's going to feed through to you and me pretty soon. So I thought you might, I was going to do some stuff on my house. I thought I might have to wait through the year. You could get into late summer and you could have big discounts compared to, a month ago.
Yeah, and that, Scott, if that coming back to that chart, that's what fundamental analysis gives you, right? And so where are we here on this chart? So let me just talk. So we hit a high of 1,700, and now we're at 864.
Man, that was fast. It went up fast. It went down fast. It really was a short squeeze. It's funny. I got really into the lumber twit, all the lumber guys who are trading futures and everything, and it was just this short squeeze where this is a high time of year to be building new units. People are working on their houses, selling. There was a selling frenzy out there in the housing market.
Yeah.
So everyone was just like, at any price, I need to buy the lumber. It's like 20% of the cost of your building a house, but it's not higher than that. So you can just eat the cost, pass it on. So it really was like a scramble, take lumber at any price. That's come off now. But, we're still way above, right? Lumber usually runs around $350 a board foot or whatever the metric is. It's still at $860. Yeah. So what's funny is the stocks are a little different than the price of lumber. You could have said, I'm going to short these stocks. Lumber's definitely falling. Some of the stocks have fallen a bit, but not as much as you would have thought because they were already pricing in, say, $500 lumber. So if we're still at $800, there's still upside. So you had to kind of know what lumber price was priced into your stock before you said, I'm going to short it or I'm going to buy it.
Yeah, for sure. And I think in this market where liquidity is supreme, and I, personally, we're at least in the Grizzle portfolios, we're not messing with any sort of we're not doing any sort of short activity on anything, right? So, keep it simple. But we do this analysis because just the amount of Fed money printing, all the rest, the amount of liquidity in the system. I'm not taking that. Why take that risk when the deck is against you, Scott? Right? You know what I mean? It's unnecessary. And but we do this analysis just to make sure that, hey, listen, could this be, could this be in the second, third inning? You got to do the sanity checks. We do it. We say, hey, listen, it's come back, and lo and behold, it comes back. Probably has a bigger impact on your decking costs, on your than your necessarily your portfolio. But all of it's still very relevant and important.
Yeah. So we looked at it as, do you want to be rushing into lumber stocks? Well, no, you didn't want to, and that ended up playing out. So, we talked about shipping, COVID-driven spike, lumber, looking like COVID-driven spike. So these are not setups where there's not enough supply to meet demand over the long term. You're going to get higher and higher prices. This was just, a one-time event. It's dissipating.
Yeah. Yes.
But then we got to move
So
to
that's
a
lumber.
commodity that is a little different. Copper.
Yes.
You know we like copper.
Yeah.
We've taken you through deep dives on copper on Grizzle Live. We've written articles about it. We've been on the pod. We got to talk about it a little bit more. Tom, take it away.
Yes. Yeah, for sure. So, we're like, look, so the chart does not look like lumber. Like, it's not like peaking out and going to the moon, right? That's what happened to lumber, right? It ended up being this, like, you're like, wait a minute, we've never seen, this is never seen anything like in the past. Very different for copper, right? We're still away from all-time highs. You're kind of getting close to all-time highs, but it's nothing happened where it just literally went rocket ship, and that's what you want to see in commodities. And net, we still think it's the most constructive of the commodity set for a simple reason, Scott. It really is. It's the bedrock of electrification. In the other parts, we're going to talk about the supply side too, but we just think on a supply and demand dynamic, it doesn't really get any better than copper. And this chart, so, we're from our perspective, it's still a very healthy chart. There isn't like a lot of bidding up it's in here. We're in a time where there hasn't been a lot of investment, and I'll touch on that on copper. So from our perspective, we think, and when you get back to the miners, right, and we're the copper miners, and we did the copper episode, didn't we, Scott? We did.
Yeah. So if you've seen that, you might have seen some of these charts, but it's definitely worth repeating because just lately, as people are less worried about inflation, copper stocks have been down lately. The commodity's been down, but you just got to step back and look at these supply-demand dynamics. Tom is a good chart to talk to next, where it just looks very strong in copper.
Yeah. So Scott, maybe we'll pull the one that looks at mining investment. We pulled that one. So let me. So there's that one too, right? So basically, what this looks at, we're basically looking at copper's fairly straightforward, right, Scott? Because you can get it's like oil and gas in a sense. There's a lot of data. You know what mines are going to come on. There's no surprises, right? There's nobody that is doing some underground copper mining.
Yeah, it's a pretty efficient market, right, as far as information.
For sure, right? In huge data sets, you can figure out what's going on. Now, the one thing that's different in copper versus oil, and I think you're going to talk to this about oil, Scott, is that it takes a bloody long time to get a copper mine on.
How long, Tom? Like, what's the range there?
Yeah, so we're looking, from the point of discovery to actually when you're pulling ore, you're looking at, in most cases, 8 to 10 years, Scott. And that's a minimum, right? But, right, like this is like you discover it, and then you got to go through permitting. Then you got to go through the environmental.
You might have to work with a government that's a little hostile, some locals that are hostile.
100%, right? And so, you like it, and this timeline isn't getting shorter, right? And ESG, environmental, social, governance, those issues continue to become bigger hurdles for companies that are extracting resources. So the hurdles end up just getting bigger, and the timeline keeps getting extended. So from our perspective, there has been a definitive a lack of investment and the elongation of the time it takes to get mines on. And what this basically shows you is, call it by the year 2024, you're going to be looking at a case where primary demand, so both production that we already have online and then probable projects that are in the pipeline, they just cannot meet the demand growth that is functionally in copper, right? And copper demand per capita, total global demand, is steady as she goes. It is one of those things. Very much, it's like energy usage globally, right? It just keeps, all things equal. And I'm not talking specifically. Well, I'm saying all energy. If society is progressing, Scott, we're all using more energy 10 years from now. And I'm talking. It could be a combination of solar,
natural gas. It doesn't have to be just oil.
Yeah, if you were to tell me that in 10 years from now, we're using less energy than we are today, that's not a good situation. And if you were to tell me that we're using less copper than we are today, that's not a good situation. So if you believe in progress, if you believe that the world continues to move forward, and we are in that camp, we're not gold bugs, we don't believe the world's going to fall apart, you believe in copper. Simple as that. So Scott, why don't we pull the next chart? Because the next chart probably tells you why, why this is, why this low investment has been happening. It really just visualizes.
Let me
right?
talk to the nuance of this chart that we're talking to. So this chart is just showing supply and demand. Demand is a line, supply is kind of like another line. And it always, if you wanted to pump up your commodity and say oil's going up, copper's going up, you can always find a chart like this, because remember, as we look in the future, there's always uncertainty because we don't know that a mine is going to be found, but it will be found. So this doesn't mean that there's going to be a shortage of copper where literally we'll run out of copper versus demand. It just means the bigger the wedge is, the mismatch between future demand and future supply, the higher the price has to be. That's the way you have to look at this. It's not we're going to run out of copper in some crazy spike. It's just pricing needs to go up to incentivize people to find all that new copper.
That's it exactly, right? And that, and if that wedge is the issue here. We will go out and search and find it, and you'll end up expanding mines, but it'll all have to be at a much higher.
And that's all we're playing for. We're saying copper prices should continue to go up because of electric vehicles, and there's not enough investment. And investment is the important part. And Tom does have another chart that just looks at the capital spent to find copper lately.
Yeah, and so this is a unique chart. Got to hat tip the guys at Crescat Capital. They do a lot of work on commodities and the like. So this is U.S. private investing in mining exploration. So basically, you had, call it at the peak in 1980, you had $500 billion being invested in mining exploration. Okay, this is shafts in the ground looking for mining ore throughout America. Now that's fallen to sub 50 billion. So that's the kind of, so you're 10x lower in terms of investment into the ground looking for ore. So if you think about it, net, all of it doesn't compute, right? You see, you've had the steady demand increase, but the actual investment in the ground has just been declining. And
to be fair, is some of this efficiency and technology being used in finding ore bodies or something like that? Is there a little piece of that?
It's not as dramatic, and nowhere near as dramatic as what's happened in oil, right? You never had a revolution like fracking in mining, right? No, yeah, and I'm not saying that there's definitely efficiencies, but bottom line is you can't, like, that 10x type reduction is not efficiency can't explain that away, right? Which you probably could see some of that in the oil and gas industry, like, oh, you're spending a lot less money, you're getting a lot more oil. Well, lo and behold, the shale revolution happened, right? So, but yeah, you don't like, mining is tough. It's a tough business, Scott. You still have to scar the earth, pull the ore out, and then put it in the Tesla. That's how it goes.
Yeah. All right. Before we move on to oil, do you have anything else you want to mention on copper for everyone?
Yeah, so just so again, we're constructive on this. Our thought process is, listen, we're not moving away. We think this is going to be one of the core commodities for this economy, the future economy. Supply demand is correct. Then obviously, if you go to grizzle.com, you can search up copper. You can see we did a big kind of overview report. The names haven't really changed. We like the small mid-cap space, Scott. I think that's an exciting space because the big guys just simply don't have the inventory, right? And so you have two choices, right? You can go through the process of drilling for finding new ore bodies, going through the process and adding it to your production 10 years down the road. Or, Scott, you can just buy somebody.
Yeah, and that's what we want to play for, right? Because when pricing's running and these big guys want to take advantage of higher pricing, as Tom said, it takes years to bring on stuff organically. So what's easier?
That's right.
You buy the little guy, you got new production today at a higher price. So we'd rather own the smaller guys that trade at a much cheaper a multiple of their cash flow to the big guys.
That's right.
Then they get bought out. That's where the big money's made as a commodity heats up.
Exactly. And let me give you a little bit of a taste for that. So the large cap copper producers, so these are the the Freeport McMorans, First Quantum Lundins of the world. They trade at 13.3 times forward price to cash flow. And again, and this is a little dated, but the relative numbers are still the same, right? So 13.3 times, and the average small mid-cap producer trades at 7.2 times.
Wow. So
right?
Almost half.
Almost half. So you get that you get that natural roll up where basically you're getting it for cheaper. It's accretive right out of the gate. You don't have to do any synergies. It just adds to your bottom line. This is how it goes. Now, within that space, we also highlighted 3 names that are like dirt cheap in the small mid-cap space, right? On a price to cash flow basis, right? So Sierra Metals on 2.5 times price to cash flow. Hudbay Minerals 3.7 times. This is all consensus. And Capstone Mining at 5.9. And if you were to look at forward price to sales, 1.4 times for Sierra, 1.3 times for Hudbay Minerals, and then 2.0 times for Capstone Mining. So again, and similar on EV/EBITDA, but bottom line is these are cheap companies, and so this is the way we think about it. Small mid gives you good exposure. We still think obviously there's a lot of talk of inflation's gone, but again, we're talking about a situation where there simply isn't enough copper mined, and you'll need higher prices to get the supply on that week.
Yeah, I think it's one of these things where if you don't have that hedge against inflation, like say you still hold on to this hedge and we're wrong and inflation is no problem, well, it goes down a bit. But if inflation is a problem, you're going to lose a lot more on other things by not having some of that exposure to help you out. So we're willing to take some losses for confirmation that inflation is totally good to go. But if it's not, then this hedges our portfolio versus other things will get hurt by that. Okay, so the last thing we're going to talk about, we got to talk about the oil markets. Near and dear to my heart. I spent 6 years in the trenches, oil all day, every day.
Guys, you're not going to learn from anyone better than Scott right here.
So first let's look at the chart of oil, seeing what's happening lately. Oil has been one of the craziest commodities in the last year. I don't know if you guys remember WTI oil price, which is a benchmark in the U.S. It went negative last year, which is, I think, maybe never happened. It was like negative $40. Now look at where we are. We're all the way into the 70s. So quite a bumpy road for oil. But now we're at that point where oil is also spiked. It's back, near where it was in 2017, 2018.
Scott, we got to take a little bit of a victory lap here. We got to. Coming into 2020, we were the only shop, period. We were the only research outfit that was saying negative on oil. We believed that it was, and especially when COVID hit too, we said, listen, this is a short. This is troubled, and no one else was calling that. And the day it went negative, we took off. We said, listen, you don't have to be short this thing anymore. Now you go long, and we went long options on all this stuff. Like if anyone followed us at that time, they would have known. They would have seen all of what we did there. But that was incredible work. Scott crushed it. This is a combined commodity experience that Scott and I bring to the table.
That's the beauty of when you do the work up front, then you're ready to execute. So a few years ago, I went down to Texas and met with all the biggest oil producers to figure out what was going on in shale and what it meant for global oil demand and supply. Figured it out, put all the pieces together. We said shale is just too fast. It comes on in 3 months. It's going to keep prices around $50 long term. Yep. Granted, we can see oil goes up and down a lot. It goes to negative 40. It goes to 70. But as long as shale can just ramp up that quickly, it's kind of capped the volatility of oil. So we knew that the best way to play oil is always just to play the full cycle. When we get into a recession and when we come out, that's when you make your big money. Once you're kind of back out and you're just in that normal expansionary period, it's very hard to make money in oil. So the options that we recommended people buy on, say, an Exxon, that was the best risk-adjusted return ever, because Exxon is a huge, stable company, but by doing the options, you get that juice like you were buying a riskier company. So I think we made about 200% on those options with very low risk. I mean, it's ExxonMobil at the end of the day.
Yeah, you know what? That's a scenario where you can go and do buy all this very, very spec stuff, and it's fine, but if you're wrong, the better thing to do is to have the company that's liquid, that has the balance sheet, and that can make it, right?
Yeah. And we also had sell targets too. So we told people kind of when we were getting out, we thought it ran too far. It ended up being a really nice time in June of 2020. Exxon went all the way back down to where it was in the depths of the coronavirus scare, and then back up big now. So now we're at a point where all the stocks have run. Oil prices are higher than I think a lot of people expected. And so if you look at the fundamentals, what's happening? Is there not enough supply for the long term, or is this another COVID-related spike? Because remember, people are now on the road. They're visiting relatives. They're taking more and more flights. And so I'll put it in context here. OPEC, which is a group of producers that have kind of colluded, and they said, we're going to decide what we produce together to keep prices where we want them to be. They've said that this year, oil demand could peak at 100 million barrels a day later in the year, kind of like the high time for driving and everything. For a little bit of, if we just go back a year ago, in the depths of the coronavirus lockdowns, demand fell all the way to 86 million. So for a market like this, even a million swing can have huge impacts on the price. So that's why when you saw oil demand was usually at 95 million, it went to 86. What happened to the price? It went from like $60 to negative 40. Right. So the price is much more volatile in supply and demand. So now you're at a point where demand is picking up quickly, and can supply ramp up to meet that? And so some smart people we follow on Twitter are saying, pricing could get even higher later in the year. I think that's possible because demand is coming back so fast. You and I just go outside, we drive. But it does take some time to drill a new well or to turn on that producing pipe if you shut it down. But at the end of the day, OPEC has a lot of spare capacity. So they are not producing all out. To keep the price high, they cut back on their supply in times where supply is exceeding demand. And this is one of those times. So as long as OPEC has more than enough capacity to meet, even as demand goes to 100 million barrels a day, that would mean that OPEC has to go from producing 25 million today to 35. They have enough production to do that. You also have struggling countries like Venezuela and Iran who would be more than happy to ramp up production if pricing is there too. Maybe they can invest a little bit more. Venezuela's in a tough spot. I mean, they used to be producing 2.5 million barrels a day. They're down to less than 500,000. But still, never count these guys out when money's on the line. Everyone a few years ago said Iran, they're sanctioned, they can't come back fast. They turned on the taps in like 3 months. So all the work we did a few years ago, it still stands as long as you have shale that can break even at around $50 and can turn on in 3 months. If pricing continues to go up and up and up, we're going to see all these new rigs come out of the woodwork. We're going to see production in the U.S. pick up. And that actually takes me to, we have two other charts just talking about the U.S. market. So number one is, what is the U.S.'s situation on importing or exporting oil? If you remember, for the last 30, 40 years, the U.S. has been an importer of oil. They didn't produce enough. But shale changed all that. Now, even with coronavirus going on and this pickup in demand, we're still exporting 3 million barrels a day. So that shows that the U.S. actually has more than enough oil.
Right.
So there's not a shortage out there, really. It's a fake shortage driven by OPEC and them holding back production. Now, the other piece of the puzzle is, well, we know that shale is the fastest production to come back on. So as pricing goes up, all these guys, they want to take advantage. They want to drill more wells. Yep. Can they do that? If we look at the rig count was up around 750 oil rigs in the U.S. pre-COVID. Yep. It fell all the way to below 300. Now we're only back to 370. So there's lots of rigs sitting in a yard somewhere that can just come back out and start drilling. So this just tells me the shale is more than happy to pick up the slack if OPEC doesn't bring all that production back on. So everything's happening fast. We have a lot of demand coming back on. You could continue to see oil prices go up this year. But as we look at longer term, I think the hot money has been made in the Exxons and all these other things. And there's more than enough supply to meet demand. Then as you get a few years down the road from there, we have all the problems with electric vehicles. If we start powering our electric vehicles with coal or natural gas, oil demand is going to be in trouble.
And so, Scott, the other mid piece to the puzzle is also the cost of capital, right? So the shale boom was driven by basically low rates, right? Very, very low, easy monetary policy. And basically you had these companies were born for nothing. what's interesting here, Scott, is junk bond yields right now are 3.84% and even lower. That was as of June 15th. The lowest they've ever been.
That's like
low.
double A, which is high quality bond yields from like a few years back. It's so cheap. So that, I mean, number one, if pricing keeps going up, these guys generate cash flow, which they actually then can just reinvest in drilling more wells. But if they needed to really ramp up even faster, well, there's cheap money everywhere. They can borrow more debt, put it to work in rigs. There you go.
And let me just put it this way, Scott. Debt investors are willing to give MicroStrategy, our good friend Michael Saylor there, zero coupon or whatever they were giving him, man. Basically, and people are like, well, institutional investors are not going to lend to shale. I say, watch it happen.
They've been lending to shale for 10 years and not getting a return on it, and they still keep giving them money.
They're still giving, and the real question, well, their hands have been burned so many times, it's not going to happen again. Well, as long as there's QE, as long as there's money printing, they're forcing people out the curve, and some new idiot will take the chance.
Yeah, someone else might say, I'm getting 0.1% my checking account, 3% on these high yield energy bonds. Sounds pretty good.
That's right. Yeah, and that's really your hurdle, right? So it's like, this will drive the market.
Yeah, so I put oil, of all the commodities we talked to today, I put copper as the only one that's sustainably on a very strong footing, where you're getting in now, you can ride this for a few years, it gives you inflation protection, plus if electric vehicles really take off, you have a big boom in demand, not enough drilling, the whole thing. Copper's set up well. All these other ones are really a COVID, go back outside, go back to normal type play. That'll settle down over time. And so these, you shouldn't look for pricing to be higher than where it is today a few years from now.
Yeah, so Scott, that was a good recap of the episode. Guys, that's the show. Reminder, we're teeing up for it. That is Monday, June 28th.
When's the tee-off time, Tom? When are we starting?
Yeah, so we're just finessing that right now. So we'll have that shortly. So it'll be
it's going to be in the morning. We're just trying to figure out the right time.
Yeah, so it'll be either 11 or 12. Just trying to work, just ensure the schedule captures everyone, and the way we're going to do it is lineup style as opposed to the panel discussion, because obviously it's a much earlier market, Scott, and each company they're actually very differentiated. So I think taking a half hour talking to each company will be far more valuable. It'll be like when Scott and I used to go to conferences.
Yeah.
We'd get a big printout of companies to go to, 2 coffees in hand, and go.
This is the inside track for you guys. We're talking to the CEOs, the leaders. Usually you'd have to, have a bunch of money invested in them or have a bunch of money in the bank to get access. No more. The future is you come with us, you talk to leaders directly. That's what we're going to do here. Exactly.
And the key thing is we keep it engaging. We keep it fun, and it's like folks were literally listening from the start of the MSO masterclass all right to the finish when the Canadian guys and our whole thing, right? So whole thing.
Yep. All right. Well, that was a jam-packed episode. Hopefully, you guys have a better handle on commodities now, and we're going to be back next week with some more podcast gold. Take it easy.